Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra and I'm joined today by our global market specialist, Oriane Parmentier. So we're recording this on Thursday when it feels like markets are still quite optimistic of a deal being reached, despite the fact that we entered the week with some escalation of tensions. We've seen gilts underperform relatively significantly, although they have reversed some of that on deal optimism. In Europe, the message from the ECB last week was very much that a hike might be warranted as soon as June unless something materially changes. Markets were very convinced last week that that meant that a hike was coming, but obviously with news of a deal, they seem a little bit less convinced, but maybe that is the best place to start. Oriane, we spoke with Giovanni immediately post the ECB last week, and we got his sort of take through an economist lens, but I think perhaps useful to understand your view from a markets perspective. Markets are still looking for more than 2 hikes, largely delivered by the end of the summer. How does that fit with your revised base case?
Yeah, so the key driver this week for European markets, as well as you've been mentioning, was the sharp improvement in risk sentiment, and it has indeed triggered a pretty aggressive rally across Europe. So markets are now seeing around 58 basis points of cumulative hikes for the rest of the year, and slightly less than a full 25 basis point move priced for June. So that's quite a shift from earlier in the week where when we had more than 3 hikes still priced in. We also seen 10-year bond yields rally by more than 10 basis points just over the last couple of sessions, which has taken them back below 3%, and curves have been steepening on the way down, and peripheral spreads have also tightened materially. So markets have moved to price a more benign geopolitical and policy outcome. From a market perspective, in the very near term, I've said rally makes sense. We've seen some easing in tail risks, and that's naturally fed through into rates, and that was a risk that we had been highlighting in the past week. But I don't think we can say that markets are, for instance, underestimating the ECB when it comes to the June meeting. We have, as I said, close to 25 basis points of hikes already priced in. So I think, a tactical move is clearly in the price. Our own expectations is that the ECB continues to sound hawkish. I think they'll continue to insist on optionality and flexibility. So this meeting by meeting approach. But it's largely, I think, to avoid being seen as behind the curve. But unless we start to see genuine second round effects coming through, which we haven't for now, I think that hawkish messaging may translate into less actual action for the meetings beyond June. And that's where I think the risks of a repricing lower perhaps are. For the June meeting, our economist, so Giovanni, sees a 25 basis point hike in June as increasingly likely, although still conditional, not because macro fundamentals demand it, but as a form of insurance to protect the credibility of the central bank. And Lagarde herself has implied that when inflation overshoots become larger and more visible, even if they are supply-driven, the central bank risks confusing its reaction function if it does nothing. And I think against the backdrop of heightened geopolitical uncertainty, the energy stress, as well as the memory of 2022, the path of least resistance for the ECB is a tactical response, likely for June. But Imogen, you were on the road last week discussing central bank expectation in detail. So can you tell us what was the consensus on the ECB before the meeting with clients you spoke to?
Yeah, consensus was very much for hikes. I would say at least 2 hikes from the ECB this year. Our sales colleagues that we were doing the roadshow with, and just for a bit of context, we were on the road seeing London-based real money and fast money accounts. I think in total, through a series of roundtables, Zooms, one-to-one meetings, etc. I think we spoke to over 40 accounts. So not that we spoke to everybody on the street, but I think we got a good sense of what consensus was and a good sense of where the majority of views lied. And in this survey that Sales ran in nearly all of the meetings, it was just a few quick fire questions asking around expectations for the Bank of England, the ECB, the Fed, gilts, oil prices, etc. But there was real conviction around the ECB hiking. And in fact, in our sort of multiple choice answers to the questions, what do the ECB do over the next 12 months? Cut rates, keep rates on hold, hike once, hike twice, etc. Oftentimes the response was, why do we have to choose only 2 hikes? Can we not have at least 2? There was a real kind of hawkish conviction, which matches market expectations, but that was very much in line with the consensus coming out of our meetings. I think there was a perception that the economy and particularly the labour market could withstand some degree of tightening, and the ECB being at neutral, particularly when we compare it to the BOE, for example, who arguably, we can probably debate the degree of restrictiveness, but we're probably all in agreement that they are at least mildly restrictive levels. The ECB being back at neutral kind of gave them more room to hike than perhaps other central banks did.
Perhaps can you tell us in a bit more detail how it compares to expectation for the BOE?
Yeah, so I mentioned obviously that consensus was quite in line with market pricing for the ECB, and that there was a lot of conviction around the ECB hiking, and in that sense, there was a lot more conviction around the ECB hiking than the Bank of England. So again, quite similar to market pricing, where it's obviously been volatile, but over the last couple of weeks, we've seen conviction in earlier and more rate hikes from the ECB than the BOE. But I would say where consensus out of our conversations really differed to market pricing was around the BOE, in that we were very much at the hawkish end of the spectrum in terms of our BOE views. And, just as a reminder to our listeners, our view is that the BOE delivered 2 hikes over the next kind of 12 months. Formally in the forecast, we have those in Q4 this year and Q1, although I think the risks to that is skewed that they come earlier rather than later. But that's not that different cumulatively to what the market is pricing in terms of total tightening to be delivered. Where we differ to the market is in the terms of the timing of those hikes. But we were very much at the hawkish end of the spectrum in terms of BOE views. Interestingly, despite the fact that the market is pricing at least 2 hikes this year, hardly any clients in our conversations were expecting Bank of England hikes. There were lots of concerns around the weakness in the economy, the slowing labour market, both kind of providing impediments to the BOE hiking, and lots of discussion around the fact that rates were already in restrictive territory, so perhaps the BOE didn't need to hike as much as someone like the ECB. But I guess the key takeaway for me when it came to the Bank of England was that it was interesting that there was just such a strong consensus that the Bank of England wouldn't need to hike, and yet that was so different to what was being reflected in market pricing, and to be honest, quite different to our own house views. It strikes me that if you think that the ECB is going to have an inflation problem that it might need to tackle, and they might need to hike, twice, potentially even 3 times, I'm not sure why the Bank of England is going to have any less of an inflation problem. But that wasn't a view that was shared amongst many of our clients at all.
Right. And were there any other key themes to come out of these meetings?
Yeah, I guess, well, partly given the timing of it, we're recording this on Thursday when polls are open in the local elections. But, away from central banks, we were focused on the politics, the local elections, and the fiscal implications. I would say that probably it felt to me like consensus was quite complacent around the fiscal risks. And that's something I think we've been arguing for a long time, but particularly in light of the domestic political backdrop, there was a real sense that even if the local election result was as bad for Labour as polls are projecting, and just a reminder, I said we're recording this on Thursday, so we don't know the results yet. I think there's a sense that it's not necessarily going to be particularly market moving. And there were sort of three schools of thought around this. The first one is that it's already priced in, the event and its result has been pretty well telegraphed. The second is that the path to a change in leadership wasn't immediately clear. You have Angela Rayner still subject to the HMRC investigation. You have Andy Burnham, not yet an MP. And the third point related to that, I suppose, is that a change in leader isn't necessarily market relevant or market moving, even if they potentially are more left leaning than the current Prime Minister Chancellor combination that we have, as there is no space in the fiscal rules to borrow more, and all incoming prime ministers and chancellors will understand where the red line is for markets that the market won't allow them to cross. On the first point around it already being priced in, I'm not trying to suggest that everybody had forgotten about local elections or didn't have them on their radar, but I do feel like the market hasn't been as focused on it as it might have otherwise been were not other major geopolitical events going on at the same time. I think we saw that at the beginning of this week, even if the underperformance in gilts wasn't about the market pricing in more fiscal, i.e. you didn't get the kind of traditional curve steepening response that you might expect. I do think that what we were seeing was a kind of buyer's strike across the curve as investors just waited on the sidelines for the event risk of the end of this week to pass before potentially getting back involved in gilts again. And I think that's how gilts were able to sustain a level above 5%. That 5% has previously been a trigger for buying flows. And I think actually those buyers just remained on the sidelines this week. On the second point around, the path to a change in leadership or a leadership challenge not being clear because of the ongoing HMRC investigation and Andy Burnham not being an MP, obviously these are hurdles, but they're not insurmountable. And I don't think it necessarily prevents a swift leadership challenge, particularly as Labour's MPs may well view, a sizable defeat in the local elections as an opportunity for a change in leadership, a kind of strike while the iron is hot moment ahead of the summer recess, which gives them quite a small window to act. And then finally, on the third point around the fact that, even if we get a leadership challenge, a change in leadership, and they're slightly more left-leaning than the current Prime Minister and Chancellor is, then actually it doesn't matter from a market's perspective because there's no fiscal space for them to do anything. Well, my word of caution here is just that this was the thinking in 2024. We had a change in government from Conservative to Labour, and the market was relatively complacent about that because there was no space in the fiscal rules for a centre-right switching to a centre-left government to borrow more. And actually, in the end, what we got was still significantly higher borrowing and a new set of fiscal rules. And so, I'm not trying to suggest that a change in leadership would necessarily bring about a Trust 2.0 moment, but I do think in an effort to secure votes from the core of the party, there will be some form of fiscal mission creep over the next couple of years, at least versus the fiscal tightening that the OBR projects. And then the final point that just came up quite a lot in the meetings, particularly when we talked about the kind of political fiscal risks, was why these weren't being reflected in FX, in the currency. You look at sterling and actually it's held up relatively well. Obviously it has versus the dollar, but part of that has been dollar weakness, whereas it's held up well against the euro, whilst gilts have underperformed. And I think I would attribute that to three things. The first is just positioning, the fact that everyone's asking questions is quite telling. The second is that maybe there's gilt-specific factors around the supply and demand of bond issuance that's driving gilt yields higher. And then the third is that perhaps there's some flows out of the Middle East that are also supporting sterling. While we are on the topic of fiscal risks, though, Oriane, I know you've been looking at supply this week and the dynamics in the euro area. So perhaps we can chat a little bit about that. What trends have you been seeing so far in euro area supply in 2026?
Yeah, so one topic that has been on top of the mind of investors this year has clearly been the maturity of issuance. So the weighted average maturity of government issuance has edged slightly lower this year in Europe compared with the same point last year. But I think it's hard to call it really a structural shift. Maturities remain elevated by historical standards. Perhaps the standout example is the Netherlands. So since 2024, they've been actively shortening the duration of the issuance from more than 14 years down to around 11 years so far this year. So that move makes sense in the context of the Dutch pension fund reform, where demand for long-end bonds and 30-year bonds has been fading in favor of the 15 to 20-year sector. But if you look at the wider European universe, and if you take into account also the size of gross issuance from each of these countries, well, the story changes, and we can say that the decline in maturity has actually been, quite modest. So I think this brings us to the key point that we've been insisting on in the past months, the heavy hitters. So the likes of France, Italy, and Germany face enormous funding needs again this year. Just to give you a number, together they will issue over €1 trillion of government bonds for 2026. So I think with supply on that scale, it's difficult to see how the long end doesn't remain a crucial part of the issuance mix. So I think the long end still has plenty of work to do here.
Do you expect these trends to continue throughout the year? And I guess if you do, what does that mean for markets?
Yeah, so there is a clear element of front-loading when it comes to supply, and new benchmarks are typically launched early in the year rather than later on. So it's usually, quite natural to see the average duration of issuance drift slightly lower as we move towards the end of the year. But that said, there are still some big tickets outstanding. For example, we're yet to see another 30-year syndication in Germany, potentially a new benchmark, and even a new 30-year EU bonds. More broadly, I would say that we're also seeing a shift in demand across Europe, and it's a multi-year theme, as I was mentioning, this Dutch pension fund transition. But we also have the theme of elevated supply, which is a multi-year story as well, I think. And as I was saying, I'm skeptical that issuers will be able to shorten duration anywhere near enough to fully match those changing demand dynamics, notably for the long end. So for market, I think it means, we should continue to expect curve to steepen as a long-term structural view.
I guess the other key theme on supply or fiscal issues has been about the defence spending. So how are you thinking about that through the rest of the year? And what are you thinking about the impact that this has on issuance, particularly from the EU?
Yeah, so when I think about defence spending for the coming years, I would say the key points at the moment is that the geopolitical backdrop makes some increase in spending across Europe hard to avoid. I would say more for coming years than just necessarily for this year, since we've already seen some increase. For now, Germany is clearly doing the heavy lifting. I think its commitment to rearming and defense means that bond supply is likely to stay elevated for years, even if there's still some debate around how quickly that money actually gets deployed and if it gets deployed. Elsewhere, the other big European issuers don't have the same fiscal space to follow Germany's lead. In particular, France and Italy are constrained, and Spain has also been quite vocal in resisting higher defense spending. So most countries, I would say, are still operating with limits. And where defense spending does increase, it's likely to come with additional market borrowing, perhaps at the EU level, I would say. That brings us to the EU. So we are already seeing a clear signal with the 20 billion euro increase in hedge fund funding that we had following Hungary dropping its opposition to the EU's Ukraine support loan. I would say that markets had been primed for more issuance later on this year, but bringing that supply forward into the first part of the year came as a surprise. I would say that looking ahead, that tells me that defense-related funding pressure is feeding through to EU issuance, perhaps sooner than it is for European at the European country level, I would say. But from a market perspective, I think while more supply could be challenging at the margin over time, I think it's supporting the EU's position. It's reinforcing its role as a regular and durable issuer, and also reinforces its sovereign-like status, I would say, in the markets. For European rates more broadly, I think increased defense spending is likely to be a headwind over time. Higher spending, higher issuance should put upward pressure on yields, and that has been a key driver behind our medium-term bearish views on goods. Although in the short term, we do acknowledge, the bullish risk for stemming from easing tension in the Middle East. But I think it's going to continue to be a driver for European rates, not just this year, but also as a multi-year story. Imogen, you've been also looking at supply this week, with the DMO publishing its response to the recent consultation on expanding and deepening the bill market. Can you tell us what we learned from that?
Yeah, so it's been an ambition of the Treasury and the DMO, or appears to be an ambition, to, as you say, expand and deepen the bill market in the UK. And they sent out a consultation to the market a couple of months ago, and we got the longer-awaited response for that this week. The key, I guess, developments or announcements within that response was that 12-month maturity T-bills, which isn't something that exists at the moment, will be introduced at weekly tenders by the end of this fiscal year. There will be a standing repo facility for T-bills that will be introduced also in this fiscal year. And finally, a T-bill collateral pool that can be employed in the secondary market, with collateral collation expected to begin shortly after the autumn budget. So 3 key developments, I would say, from their response.
And do you think this is sufficient to create a deeper bill market?
A couple of points I would make. The first is that the devil will really be in the detail. The exact parameters of the repo facility will define its effectiveness, and those parameters won't be announced until the autumn, and then only set up before the end of the current fiscal year. The second point is that means that the broader timeline for changes is still quite long. So, it's the autumn budget at the earliest for any more detail, and then implementation after that. So whilst bill issuance numbers could grow significantly, I think it's unlikely to be this fiscal year. As a reminder, bills make up just 5 billion of that net financing requirement this year. And then the final point I'd make is just on the leverage ratio, or lack of information about changing the leverage ratio within the consultation. I mean, the response notes that multiple times, in fact, that this is the responsibility of the Financial Policy Committee rather than the DMO. And so whilst they've made steps to deepen the bill market, like creating a functioning repo facility, that's perhaps necessary, but not sufficient without other regulatory framework changes. The Financial Policy Committee reviews the leverage ratio framework every September. So I would assume that this year that would occur ahead of the autumn budget. So it's not obvious to me on that time horizon, i.e. ahead of any specific details on the Treasury's or DMO's plans to deepen the bill market, that the FPC will be adjusting the leverage ratio framework anytime soon.
And would you say that a deeper bill market meaningfully changed the funding dynamics for the UK, or is it more of a marginal adjustment?
It could be meaningful. I mean, as I mentioned, there's kind of scope to increase the stock of bills for debt financing quite considerably. At the moment, bills contribute just 5 billion of that 300 billion debt financing requirement. And when you look at the UK's bill stock versus its peers, particularly versus France and Italy, it is much smaller. But as I said, this will take time. It's not something that's going to change overnight. And, in terms of what it means for the market as a whole, or certainly for the gilt market, I think there's reasons to be both positive and negative about this. I mean, positive in the sense that a truly deeper market could potentially significantly shrink the duration of issuance. Like I said, it's the UK's bill market is much smaller than France's and Italy. So there is scope to rely much more heavily on bills as a source of funding in line with other countries. It might take a while, but that possibility is there, and that significantly reduces the kind of amount of duration hitting the market, despite the fact that government borrowing needs aren't going to shrink significantly over the next couple of years, we think. The negative is that, of course, this would significantly shrink the weighted average maturity of issuance. And the shorter that is, the more sensitive your interest costs are to the monetary policy environment. Of course, that's a cycle, but it's a problem for a country where A, we expect rates to rise, B, that neutral rate may be higher than in other countries, and C, where the net interest cost is already so huge and a big part of the UK's fiscal sustainability issue. And perhaps the final point I'd make is just that it's a very open question for me still as well about whether those that are going to be buying 12-month bills, for example, are a truly separate pool of investors to those that are going to be buying short-dated gilts. So does a deeper bill market actually just cannibalize some demand for gilts slightly further up the curve? Okay, that's probably enough of what we've been looking at this week, but maybe we can think about, very quickly to finish it off, what we're watching in the week ahead that may well be going under the radar a little bit. Oriane, what's that for you?
Right, so one thing I will be keeping an eye on, and I'm afraid we're back to supply again, is the EU's choice of issuance next week. So specifically whether they tap the 2055 or the 2040 EU bond. And it does matter. So if they tap the 30-year bond in May and then the 15-year bond in June, I think that makes it more likely we see a new 30-year syndicated deal in July, and that would, to me, be a fairly logical sequencing. If they do the opposite, so tap the 15-year first and then the 30-year in June, I think that sends a different signal for markets. And I think in that case, a new 30-year EU bond probably gets pushed out to September or even October, which is perhaps starting to feel a bit late in the issuance calendar. What about you, Imogen?
It's a bit sort of tangentially supply related for me as well, I'm afraid. But I will be watching the mediums QT auction next week. So, I mean, there's generally more demand in the UK, I think, for medium bucketed bonds than longs. But the latest long auction, which happened last week, didn't go particularly well. So I think it'll be interesting to see how well received the mediums bucket is. I don't know that it's necessarily that meaningful for the pace of QT going forwards, but I think it will be an interesting data point. One bad auction perhaps isn't sufficient to move the needle for the BOE when they think about the pace of active sales in the year ahead. But if all those auctions start going poorly, then maybe it might be a little bit more of a cause for concern. So that's something on my radar for next week. Okay, I think that's enough for this week. Thank you, Oriane, for joining me. Thank you to our listeners for listening in. Just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. And don't forget to check out our other NatWest podcasts either, The Currency Exchange and Trade Links. Thanks, see you next week.